All right, let's dive into one of the biggest questions in all of finance. How do you build the perfect investment portfolio? We're going to go on a little journey today, starting with the Nobel Prize winning theory that really kicked everything off. And then we'll see how the smartest minds on Wall Street are trying to build on it and even break it today.
So, yeah, it really all boils down to this one question, doesn't it? Whether you've been investing for decades or you're just getting started, this is the puzzle we're all trying to crack. What's the absolute best way to put our money to work?
The minute you decide to invest, you're hit with this classic problem. Let's call it the investor's dilemma. On one hand, you've got almost perfect certainty. You can buy a government T-bill, get a guaranteed return, but, it's pretty low. On the other hand, you have the opportunity for much bigger gains, like with the S&P 500, but that comes with a ride that can be, well, a little stomach-churning. Okay, so let's put some real numbers on this to see what we're talking about. The T-bill might give you a rock-solid 2.5% return with, look at that, zero risk. Now, the S&P 500 might average a 4.5% return over time, way better, but, and this is a big but, look at that risk number, the standard deviation, 11.1%. That means the journey's going to be a whole lot bumpier. So, what's the play? Play it safe for a small gain, or do you swing for the fences?
This is where things get really interesting. Back in the 1950s, this brilliant economist, Harry Markowitz, comes along and proposes a solution that, well, it sounds like simple common sense, but it was absolutely revolutionary. He basically put the math behind that old saying, don't put all your eggs in one basket. And just like that, modern portfolio theory was born.
What he did was break it all down into a really logical three-step process. Step 1, you make your best guess, your forecasts, about how different investments might do. Step 2, you figure out all the possible ways you could combine them. And then step 3, you pick the combination that gives you the highest utility. That's just a fancy academic word for the portfolio that gives you the best possible bang for your buck, for whatever level of risk you are comfortable taking on.
And this, right here, is where the real magic happens. It's the magic of diversification. The huge insight is that if you mix together assets that don't move in perfect lockstep, they're not perfectly correlated, their individual ups and downs can start to cancel each other out. And what does that mean? It means you can actually lower the overall risk of your portfolio without giving up your expected return. It's pretty much the closest thing to a free lunch you'll ever find in finance.
And all of this thinking leads us to one of the most iconic charts in finance. Seriously, it's called the efficient frontier. Think of this curve as the absolute best you can do. For any level of risk you're willing to accept, a portfolio on this line gives you the highest possible return. It's that simple. If your portfolio is anywhere below that line, it's just, it's inefficient. You could be doing better. Markowitz's work really flipped our understanding of risk on its head. The big takeaway is that the risk of a single stock doesn't really matter in isolation. No, what truly matters is how it dances with all the other investments in your portfolio. That relationship is called covariance. And this single idea laid the groundwork for a whole new model for pricing stocks, the capital asset pricing model, or as you probably know it, CAPM.
And KPM boils all this down to one single elegant number. You've definitely heard of it, beta. Beta is the measure of the risk you just can't get rid of through diversification, what we call systematic risk. It just tells you how much a stock tends to zig and zag when the overall market zigs and zags. A beta of 1 means it moves with the market. A beta of 2 means it's twice as jumpy.
And the theory itself, it's just beautiful. It's so clean, it predicts this perfect straight line relationship. The more market risk you take on, in other words, the higher your beta, the higher your expected return should be. It has to be to pay you for taking that extra risk. Simple, elegant, and it seems perfectly logical. I mean, it's a fantastic theory, right? So logical, it makes so much sense on paper. But, and this is the billion-dollar question, does this beautiful idea actually hold up in the messy, chaotic, unpredictable real world? When researchers crunched decades of actual market data, did they find that perfect straight line? And the answer, when people actually looked at the data, was a huge, resounding nope, not even close. What they found was that the real-world relationship was way, way flatter than the theory predicted. In fact, low-risk, low-beta stocks actually delivered much higher returns than they should have, while the highest-risk, high-beta stocks seriously underperformed expectations. The beautiful theory was broken. But here's the cool part. For investors, this gap, this failure of the theory, it isn't a problem.
It's what the quants call an anomaly, a pattern that just shouldn't exist according to the old models. And you know what? Where there are anomalies, there are almost always opportunities. And this discovery basically created a whole new way of thinking about investing. People started calling it style investing, or you might hear it called factor investing. The whole idea is to stop focusing only on market risk and instead build strategies that systematically go after these specific, persistent anomalies. So let's talk about the most famous style of them all, value. This is the classic Warren Buffett approach, right? You're basically a bargain hunter for stocks. You're trying to find companies that look cheap compared to their real fundamental business value, things like their assets or their earnings power. And when you look at the history, man, the evidence is just jaw-dropping. Over a 65-year stretch, the cheapest stocks, the value stocks, returned about 17% a year on average. The most expensive growth stocks, only 10%. That huge gap is what we call the value premium, and the classic KPM model has absolutely no explanation for it. Okay, now let's flip the script and look at a style that feels like the total opposite of value. It's called momentum. This strategy is built on a really simple idea from physics. An object in motion tends to stay in motion. So you buy the stocks that have been doing really well recently, the winners, and you sell or even short the stocks that have been doing terribly, the losers. And believe it or not, the evidence here is just as powerful, if not more so. Over that same long period, the winners cranked out an incredible 18% average annual return. The losers, they barely scraped by with 3%. This is the momentum premium, and it's another massive anomaly that the classic theories just can't explain. So you've got these really powerful patterns, right? Value, momentum, and there are others too, like quality and low volatility. So what did Wall Street do? They packaged them up. This is where you hear the term smart beta. The idea is to create investment products that give everyone systematic access to these premiums, going way beyond just owning the whole market. But this, of course, kicks off a massive debate among the smartest people in finance. Why on earth do these things work? On one side, you have the rational camp. They say this isn't free money. Value and momentum stocks are just riskier in ways the original CAPM didn't capture. On the other side, you have the behavioral camp. They say it's all about human psychology. We overreact to bad news, creating value stocks, and we underreact to good news, creating momentum.